Good evening, all. Thank you all for joining on this evening for this wonderful session on asset valuation and impairment under IFRS, and then impact of that on realization basis election for corporate taxes. So it is an interesting one, a combination of IFRS and corporate taxes, which is the most interesting one and important one at the moment, given the scenario that we all of us are busy in filing the corporate tax returns. So having clarity on this topic is definitely helpful. So that is the whole idea and objective behind bringing this topic in front of you all. And I definitely thank our speaker of the day, CA Ranjit, for taking out time. He has been traveling. He was traveling yesterday, and then last evening he came here to Dubai, and he took out time for preparing the presentation as well as the engaging question and answers for us. So thank you very much, Ranjit, once again for taking out time and able to share your wisdom with all of us. And without waiting further, I would like to invite our chairman, CA Prakash Agarwal ji, to share his kind words to take it forward. Over to you, Jay.
Thank, thank you, Balram bhai. Thanks a lot. Important session today. One more announcement has come. We have already seen that yes, somewhere the depreciation rates will also be coming in for taxes by Federal Tax Authority. Again, a welcome move. Somewhere it was required, and we'll see more sessions around it. But yes, one thing which we always want clarity is how does realization works and how exactly impairment will help. Our impairment will be taken care in our corporate tax filings. One area. And as we said, this time we are doing online sessions for you so that our work is done along with our learning should not stop till the time we have a physical event. So to ensure that you learn, we are having these sessions and you'll see more of sessions coming every month. We'll do 2 sessions together. One thing which I've told in the last event as well, let me again say in this event, anyone who attends these online sessions, chapter will give you the CP hours, which will come under unstructured learning. Please understand, this will not be a structured learning. This will be called unstructured learning, but only to those members who attend 75% or more of these sessions. So if it's 2 hours, you have to ensure that you are 1 hour, 30 minutes and more in the session. If you drop before that, please do understand that as chapter, we don't have the mandate from the ICI India to give you CP hours. In this case, you have to go for self application for CP hours. Okay, I have seen these questions coming in. That's why I'm giving you a heads up. Now back to Balram. Quickly, you can introduce our speaker. He's our own member, and have a learning session, have a fruitful session, and learn. This is what I wish everyone. Learn and grow is the mantra for the year. Thank you.
Thank you very much, Jay Bhai. Thank you for your introduction and inputs on the topic. Ranjit has been our own member, as he mentioned, and he has about 22 years of experience in accounting, finance, and taxation field. And he is currently serving as a financial controller for Middle East at Crowforward and Company, a leading US-based firm where he manages financial operations including US GAAP, IFRS reporting, taxation, SOX compliance, and process optimization. His role also involves overseeing financial transaction system implementations and policy development, reflecting his focus on strategic financial management. In addition to his corporate role, C. Ranjit is actively involved in professional education, which is what he is doing currently with all of us. He has been there in many other occasions also, sharing his wisdom with all of us. And his expertise is in IFRS and UAE corporate tax primarily. He is also a certificate. He also shares his knowledge and is a regular trainer on certification courses on IFRS and UAE corporate taxes. His commitment to the profession extends through industry engagement and thought leadership. He has conducted sessions on key IFRS topics, including IFRS 18 and consolidation, at platforms such as ICA Dubai Chapter and Fintedu. As a founding member of Taxation Society, he plays a vital role in promoting knowledge and dialogue around taxation and financial reforms in the region. So, thank you very much, Ranjit, once again for taking out time. And without further delay, I would like to invite you to take it over.
Thank you. That starts, Ranjit. Catherine, has the recording started? We have to record this session. I doubt that recording has not started for this session.
It started, sir. It is on recording, sir.
Perfect. Thank you very much. Ranjit, over to you. Thank you.
Okay. Thank you, Balram. Thank you, Jay, and thank you all the committee members of ICA Dubai chapter for giving me an opportunity to speak in front of the members. So let us start. And good evening, everyone. So good evening to all the members to spend their Thursday evening for the learning session. As we know, always whenever we have the sessions, people comes in large numbers. So that shows the appetite for all our members to do the learning, right? So let us start. So again, once again, good evening and thank you for the attending the session. So what today's topic, as we have discussed, is on asset valuation and impairment under IFRS. And especially we will focus it from the corporate tax angle as well, because one of the important part in the corporate tax is to elect for the unrealized gains and losses, whether we have to tax it on realized basis or whether we have to tax it on unrealized basis or to follow the IFRS is the question, right? So since we are following IFRS, there are so many places where the assets accounting is not done on a realized basis, or so many items that goes to the income statement as well as the other comprehensive income, which is not at realized. So that is why the tax people are giving an option, whether we have a choice, whether you want, if we have the cash flow, we can pay tax now, or if you don't have the cash flow, wait until you actually sell the asset and receive the money and then pay the taxes. So we are not going much into the corporate tax as we know, but we are just focusing more on IFRS and which are the ankles or which are the standards or which are the areas in the asset standards from IFRS that we have to see and how that impact our profit and loss account or the other comprehensive income, wherein we have to see how we will calculate the taxable income from our accounting profit. So that is what we are going to discuss for today. We'll just start with the introduction of asset and how the assets are accounted under IFRS. Then we just go to the reference of the UAE corporate tax law on the measurement of asset. Then we will discuss some of the specific standards relating to the non-current or current asset, which are the main standards which affect the realization basis. And I think I have not included any financial asset or liabilities here because we know that last month we had a full session on financial instruments. So and one thing is that we have limitation of time, so I am not touching the financial instruments part. I am touching on the other assets only, and we'll have the questions as we go on. So that is how we move along, right? So if we go for the assets under the IFRS, so how we account for the asset? Normally, to account the asset, we should have some condition. First itself, we have to meet the definition of the asset. The second thing is that we have different accounting standard, which gives the recognition principle with respect to the asset. And the accounting standard or the IFRS itself gives the measurement principle with respect to the asset. So we have to account for the asset on this basis. First, we have to see whether a particular item meet the definition of an asset. If the definition is not met, it is outside the purview of an asset. So the only place where we can put that is the income statement or the profit and loss account. Then we have to go to the specific standard to see where the asset needs to be accounted. And then we have to follow the measurement principle of the respective standard. If we take the list of the standards where the assets are covered, we'll have the various standards which covers the asset, which is IAS 16 property, plant, equipment, which is the tangible asset, IAS 38 which deals with intangible asset, then IAS 36 deals with impairment of asset, IAS 40 deals with investment property, IFRS 5 deals with accounting for asset held for sale, IAS 2 is on inventories, IAS 41 is on agriculture, IAS 23 is on borrowing costs, then we have IFRS 16 leases, and IFRS 9, which is financial instruments, which deals with the financial assets and liability. So this is how we took from the IFRS, which are the standards which have the accounting for the asset or from where the asset goes to the balance sheet. So how we account for the asset, as we say, first we have to see what is the definition of the asset. So asset is defined under the conceptual framework. So what is the definition of the asset? So asset is defined as a present economic resource that is controlled by the entity as a result of the past event. So what is actually an economic resource? Economic resource is actually a resource wherein we have a right to produce the economic benefits, right? If we see this definition, and if anyone remember the old definition of an asset, what is the difference? Or is there any difference? Anyone can put in the chat. Control definition is already there. Yeah. So actually, if we see that old definition, what the asset is defined as, previous definition is an asset, which is the one which has the potential to, or we have the expectation of economic resources, or there's a probability that the economic benefit will flow to the entity was there. So that has actually not in the new definition. What the new definition says that it defines the asset as an economic resource which have the potential to produce the economic benefit. So it is not necessary that there should be a case there is a probability that we will receive the benefit. But even if we don't have a probability now, which says that, okay, we have an asset or we have an item which gives as a future benefit, it is not necessary. The asset have, even if we have an asset which has the potential to give the future benefits, then we can recognize that as an asset. So that make some difference in asset accounting, because some cases what happen is that as of now, we have an asset that has the potential. Maybe we have a startup, we have purchased a machinery, the machinery is lying there. As of now, we are not using it. So what if we ask the entity, what is the probability that we will receive benefits in future? As of now, we cannot say it. But can we use that asset to generate economic benefit? Does that asset has the potential? If the answer is yes, we are able to recognize that particular asset. That is one of the important change in the definition of the asset as per the conceptual framework, because that takes into account the different types of asset, because earlier we were relying only on the physical asset. So we have a lot of asset in the form of cryptos, all those bitcoins, all those assets. So it has the potential, then we can record for the same in our account. And the three things that arise from the definition, one is a control aspect. Always we can record an asset only if the entity have the control over the asset. If you don't have control, we cannot record the asset. Again, the control is not ownership. It includes ownership as well. But even if we don't own, we have control of the asset, we can record that. That is where we account for the right of lease as our asset. And also it arises from, we should have a previous transaction which should have result in the control, and that should be a resource on the reporting date from which we are subject to receive the economic benefit. So that is how we account for the asset. Then how we classify the asset, as we say, we have an item as per the standard, or how it goes to the respective standard. Usually an item is classified as an asset, and what type of an asset is basically determined on the basis of for what purpose we are holding the asset, right? So if the purpose of holding change, then the category of the asset change. And even if we refer to the IFRS, the standard which is applicable shall also change, right? So that is where we have to just have a discussion, right? How the asset goes to each of the standard, or what is the, we have to see for what purpose we are holding the asset. And if there is a change in the purpose of holding, even the nature of the asset shall also change, right? So if an asset is held for sale, usually if it is our business asset, we are going to sell that in our ordinary course of business, or for which we are to earn revenue. That is usually classified as inventories, and which goes under IAS 2. If we have an asset, but that asset is not part of our normal business activity, any other asset, we are holding it for sale, it is not our inventory, because it is not the asset that we deal in our normal business activity. We have a building, this is an old building, we no longer need it, we have to sell it, so we decided to sell it. It is not our inventory, so it will automatically go to another standard, which is IFRS 5, which is a non-current asset held for sale. If you're having an asset which is to be used in the business, and for purpose of the running the business, and for the purpose of earning the revenue, and we are not going to sell those assets as such, that will be falling under IAS 16 property, plant and equipment, if it is a tangible asset. If it is an intangible, it goes under IAS 38 under the intangible asset. Here also there is a difference. If we are using the asset for the business, and if we have a land and building which we are not using for our business, and it is purely held for earning rentals or earning capital appreciation, definitely it will go to the another standard. It will become our investment property, which is covered under IAS 40. But if we are not holding that asset for rentals or capital appreciation, we are using the same land and building for the purpose of our business. It still remain under IAS 16 as a property, plant and equipment. We have another category of asset wherein we are holding the asset for the purpose of construction, right? So we are constructing or we are developing a land or we are developing or constructing a building or maybe the apartment or maybe office building. If it is we are constructing not for our own purpose, it will go, we are going to construct it on behalf of our client. That actually goes as an asset which falls under the IFRS 15, which will be our contract asset, wherein we have to sell that asset to the customers. But if we are constructing for our own purpose or for our purpose is to future, we have to give it on rental basis. Then it may be either our own property, which falls under the property, plant, and equipment, or it will go to the investment property if it is a land and building, or we are going to earn it for rental. If it is a biological asset in the form of living plant and elements, like we have poultry farm, we have agricultural, all those assets, they are living plant and element, that will fall under the other standard, which is agriculture IAS 41. Basically, that is why we will wonder why agriculture is included in the asset. Actually, the name of the standard is agriculture, but here also the standard is talking about the biological asset and agriculture produce, whatever is about the assets only, but the name is only agriculture because it is talking about the agriculture related asset. So that is why that will go there. If we have any monetary or financial asset in the form of investment, shares or loan receivable, that will be taken care by the financial instrument standard, which is obviously IFRS 9 or IAS 32. That will be classified as a financial instrument. If you are holding the asset as a right of use, we are not owning the asset, but we hold it, that will fall under the IFRS 16 leases, right? So that is how we have the categorization of the asset. So we have to see what is the purpose for which we are holding the asset. Based on that, the category of the asset will come. If we change the purpose, automatically the nature of the asset will change, and coming from the IFRS or a standard point of view, it will move from one standard to another standard. Say for example, I am having a building. As of now, I am using it for my office purposes. So that will fall under a property, plant and equipment as per IAS 16. But next year onwards, I decided that no, I'm going to vacate there. I'm going to give that building on a rent to someone else. So automatically that will change the purpose. We are holding that building for rentals. So it will change from immediately from the property, plant and equipment to investment property. Maybe next time I say that I have also a real estate entity. So this building, I will include in that real estate, and then I have decided to sell. Automatically it is held for sale. Then it will move into the inventory. So automatically, whenever the purpose changes, the type of the asset or the category of the asset will change, and the standard to which the asset applies or will also automatically change. So we need to see for what purpose we are holding the asset. That determine the category of the asset and the applicability of the standards. Then if you go to the entire life cycle of an asset accounting, say by how the IFRS deal with the accounting for the asset. So usually it starts with the asset identification and recognition. That is what we have just discussed. So we have to identify what is the asset and how we have to recognize the asset. So basically two things are to be there. First thing is that it have to meet the definition of the asset. It have to meet the recognition condition of the asset. So usually all the standard have recognition condition. The main one is the probable future benefit and the measurement at cost. So these are the two things. So even if we have the probability to receive future economic benefit and the cost of that item can be measured, we can recognize that asset. Then we will see what is the purpose for which we are holding the asset. Based on that, we have to categorize that particular asset. What is the next step? So once we have the asset which is recognized and we decide that we can record that asset in our books of account, automatically it comes as the initial measurement. So automatically how we measure it. So in general, all the assets have to be measured at cost. And also it is not only the price at which we purchase the asset, but also we should have to see what are the other costs that we have to capitalize in respect of that particular asset. So this particular point is also very relevant from the point of your corporate tax as well, because if you know what are the expenses that is allowable as a deduction, what are the two main condition for expense allowability? Anyone?
Can you repeat the question, Ranjanji?
Yeah, actually, what are the two main conditions for allowing an expense under UA corporate tax? I'm not asking an accounting standard question. I'm just asking a corporate tax question. Yeah, it's not related to asset. I've just asked what are the condition to allow an expense for the purpose of corporate tax. Yeah, first answer is correct. Incurred for the business purpose. Yeah, that is correct. There is one more condition that is related to asset. First is that it should be wholly and incurred for the purpose of business, that everyone is answering. Second thing, it's exactly who we as not in a capital nature, right? So expenses should not be in a capital nature. These are the two conditions to allow an expenditure under the corporate tax law. What the corporate tax law says that what is a capital expenditure? So it says that a capital expenditure is an expenditure which is a capital expenditure as per the relevant IFRS. So that means we have to be very careful here. Like whatever the accounting standard says that, or whatever the accounting standard allows to be capitalized as part of the cost of the asset, it will not be allowed as an expenditure. So we should have to ensure that what are the costs that the accounting standard allow to be capitalized, that should be form part of the cost of the asset, and that should be capitalized as part of the cost of the asset. So if IFRS does not allow an expenditure to be capitalized, it is automatically a revenue expenditure and it goes to the profit and loss account. And obviously, the corporate tax will allow that expenditure as well. So that is the thing. So we have to be careful here while we have to follow the respective standard and see what expenses can be capitalized. And there is one more thing here. If we have capitalized an expenditure which is not allowed for corporate tax purposes, the law says that you will not get depreciation to that extent of the expenditure. So one example, the gate itself is that we have incurred some fine during the construction of the building. As per IFRS, we paid the fine because without paying the fine, we cannot continue construction of the building. You have added the fine and capitalize it at cost of the building. Fine, no issue. When you calculate depreciation, that portion of the depreciation related to the fine, which is otherwise a non-allowable expenditure under the corporate tax law, to that extent, depreciation will not be allowed. So that also we need to be careful while capitalizing the cost. What is the next thing? Next part, once we have initially recognized it, as we say, mostly the initial recognition should normally or generally at cost in respect of the non-current and current asset, or we can say that with respect to the non-financial asset. Now comes the subsequent measurement, which is mostly the cost model or revaluation model is a model that we use for the subsequent recognition of the asset. So here is the one area where we have the unrealized gain or loss that comes normally to the income statement or to the other comprehensive income. So we have the subsequent measurement. Then we'll have depreciation. So usually the assets which are subject to depreciation have to be depreciated over the useful life. Then comes the impairment accounting. So whenever the assets are subject to impairment, we have to account for the impairment. Then finally, we have the derecognition or disposal. Whenever the asset is no longer required, we have to derecognize and actually dispose of the asset. Then obviously, the standards have the respective disclosure with respect to the asset. Right. So here, what all things we have to see, as we say, with respect to initial measurement of the asset, we have to see how the expenditure or what are the costs that we can capitalize with respect to the asset, and with respect to what goes to the profit and loss account, what goes to the income statement. That is one of the important things that we have to see with respect to the initial measurement of the asset. Subsequent measurement, if we apply cost model or revaluation model or even the fair value model, to some extent, there is an impact in the profit and loss account and there is an impact in the other comprehensive income. And more or less, this increase or decrease is actually an unrealized one. So we have to see what impact we have. Depreciation also have an impact on P&L. impairment accounting also have an impact on our income statement, which may either affect profit and loss account or other comprehensive income, which is based on the method that we are using for the subsequent measurement. And finally, the derecognition or disposal of the asset should also have an impact on the P&L, because the gain or loss on derecognition or disposal of the asset should have to ultimately go to the income statement or to the profit and loss account. So that is how the entire cycle or the entire accounting that we have to see with respect to the asset as per the standard. So if we have, just let us pause for a small question here. We have just discussed about the asset. We have one question here: which of the following best defines an asset under IFRS conceptual framework? So can we put the answers in the chat?
It seems like we have.
Yeah. So most of the answers are coming. So I think most of the correct answer is coming. So we just discussed the definition. The correct answer is C, because it is a present economic resource controlled by the entity as a result of the past events. Right. Let us have a quick one more question here. So how a tangible asset is generally measured on initial recognition? Again, the answers all are giving correct answers. So again, the answer is C. So it's at cost, including all directly attributable costs. So that is how we recognize an asset initially, basically tangible or intangible asset. Right? So let us move on. Now, if you refer to the asset valuation model, we discuss about the asset valuation. So we just have basically three models of valuation of the asset, which is spread across the various standards. The basic model is historical cost model, wherein we just start with the original cost of the asset. We have the depreciation, we'll have the impairment loss that will give us the net book value. We have the fair value model, wherein if impact in two places, it should either go to the profit and loss account, which we call as fair value through profit or loss, or it will impact the other comprehensive income. So we'll have a fair value through other comprehensive income. And usually, if we use the fair value model, the assets are recorded at the fair value at each year end. If it is fair value through profit and loss, the increase or decrease will go to profit and loss account. If it is at fair value through other comprehensive income, the increase or decrease will go to the other comprehensive income. So usually we don't charge depreciation under the fair value model, and in normal cases there is no impairment as well. This fair value through profit and loss account we will have, usually we use for investment property, the financial asset as per IFRS 9, and the biological asset, wherein the change in the fair value always goes to the profit and loss account. Fair value through other comprehensive income is also applicable to those financial assets which are designated at fair value through other comprehensive income or hedging instrument, right? So revaluation model is a bit different. So wherein we revalue the asset. So basically what we are taking is a fair value, and that is how we are revaluing the asset. But that is a little different from the fair value model, because it is only a choice based on accounting policy. We can make the timing, and there is a difference as well. Like we can even charge depreciation if you are following the revaluation model, and if there is an increase, basically it goes to the other comprehensive income. If there is a decrease, it goes to the profit and loss account. Still we can charge depreciation and there will be impairment. So usually this model is available only for three categories of asset. One is IAS 16, which is property, plant and equipment, IAS 38, which is intangible asset, and IFRS 6, which deals with the exploration and evaluation asset, wherein we'll have this model. So this is the difference between these two. When we go to the asset, we will see that as well, because in the case of, even though the effect is same, we are calculating the fair value and restating the asset at the market value or the fair value, but the way in which the accounting is done is different. If we follow historical cost model, basically it does not result in any unrealized gain or loss. But whenever we follow fair value model or revaluation model, that result in an unrealized gain or loss, which has an impact in the profit and loss account, right? So usually we know that realized gain is a case where when we actually sell the asset, which directly goes to the profit and loss account. When we have an unrealized gain, if we have a change in the value of an asset, like we restate the asset at fair value, or we use the revaluation model and take the asset at the revalued amount, there should be an increase or decrease in the value of the asset, which either goes to the other comprehensive income or the profit and loss account. So that is where the tax law says that you have an unrealized gain or loss in your income statement or profit and loss account, that you can see when you have to offer for the taxation, right? So that is the next thing. So we know thus we have basically two things. First is that we don't have to make any option, or if you don't give any election, it will go as the automatic way. All assets and liabilities, the taxation will be on the unrealized basis. So that means whatever accounting adjustment that we are following as per IFRS, the same thing that we have to offer for taxation. So basically, that does not result in any adjustment between the accounting income and the taxable income. We have accounted for a realization gain, fine. So we have to pay tax on that in the year in which the realization unrealized gain happened or the revaluation gain happened. So we don't have to make any adjustment if we have not selected any election with respect to that. But if we have elected for that, and again, we have two types of election. One option is that we can select for all assets and liabilities that are subject to fair value and impairment accounting, or we can restrict only to the selection only to the capital assets and liabilities, and for the assets and liabilities which are on revenue account, or basically which are the current asset, we can follow on the unrealized basis. And only for bank insurance, only option 2 is available, that everyone knows. We are not going to deep into that. But for other type of taxpayers, we can either choose based on our, so we have to carefully select the election, because as everyone knows, it is an irrevocable election as well. So here, what we are seeing here, or why the tax authorities have given this election, is that as we know that IFRS is the basis of preparation of the financial statement. And whenever we follow IFRS, there are a lot of unrealized gains or losses that goes to our income statement, automatic income statement, and there is no cash flow. If we have actually sold the asset, we have sold the asset, we have a cash, and we have received the money, so we can pay tax on that. But if you have simply, we have a land, we have taken the land at the fair value and recognized 1 million in our income statement, so we have not received that money. So if we have to pay tax at 9% or whatever is your total income on that. If you have the cash flow, no problem, you don't have to do any election, you can pay the tax now. But if you feel that I don't have the cash to pay tax, or I have to keep the cash until I actually receive the cash, you can give the election, so that the gain should be taxed only when you actually sell the asset and the gain is actually realized. Until that, the gain is taken in care. So that is what the election means, right? So here it speaks about the asset subject to fair value accounting as well as impairment accounting. So we already discussed about the fair value. So here, what they mean by fair value accounting covers both the fair value model as per IFRS as well as the revaluation model under the IFRS. So which includes like wherever we take the asset at the current market value, that applies to the financial instruments as well as a non-financial asset, including PP, investment property, all the asset where we use the fair value, and it even apply to the impairment. So what is actually impairment? So impairment is actually a reduction in the value of the asset. There are two types of impairment. One is an impairment which is a general, which is as per IAS 36, wherein based on the indicators, we have to check what should be our carrying amount and what is a recoverable amount. So based on that, if we feel that whatever is the value at which the asset is stated in the balance sheet is not as much equal to our recoverable amount, we have to take a loss into our profit and loss account, that also we are not selling the asset, we are just keeping that loss. That general impairment apply to PPE, investment property at cost, intangible asset including goodwill, and the financial asset which are in the nature of group investment, like I have an investment in subsidiary, I have an investment in joint venture or investment in associate, to which the general IAS 36 standard applies. We have other impairment. We have impairment as per IFRS 9 for the financial asset, as well as for trade receivables, which we all know in the form of expected credit loss, and for the contract asset under IFRS 15. And also, there is an impairment model under the other asset. So even though it is not directly called as impairment, inventories are subject to write down. And if we have any non-current asset held for sale, that also is subject to the write-off or impairment. So all these things are also unrealized. So basically, impairment is an unrealized loss, but it is not a permanent one. So usually, if we have an impairment, we can reverse the impairment as well. But to that extent, whether it is realized or unrealized, we have to be, depends upon whether it is taxed or not, depends upon what we have elected or not. We also have other gains. So basically, whenever there is a change in the value of an asset with no transaction takes place, one of the example is the foreign exchange gain or loss. We have any asset or liability designated in the foreign currency. And again, we have to take it based on the rate that is based on the balance sheet date. So if we revalue it, maybe if obviously it is a higher amount, we will result in an exchange gain or loss. That also comes into the category of foreign exchange gain or loss. So that is all these things that we have to see with respect to the option that we have to take. All those what we have to take is as per this. I think there's a question. Asset held for sale are at realizable value. Why would there be an impairment? No, actually, what we are saying is that whenever we categorize the asset as held for sale, we are actually doing an impairment. We are not impairing the asset. I didn't say that, or it doesn't mean that we have to impair the asset held for sale. What comes in the other category, when we move an asset to a asset for held for sale category, that time we are valuing it. So that is actually an impairment, or which is actually an unrealized gain or unrealized loss actually. So that comes in that category. That it's another impairment. It is not an impairment under 36, but it reduces the value of an asset. That comes in the form of an impairment to the asset. That is what I meant. I think I answered that question. Okay. So that is how we deal with that. So what we do is that, so we will see through the various standards how these things are getting affected, or what are the points that we have to see with respect to the accounting of the asset as per the IFRS. And we have to see what all items that goes to the profit and loss account, and how it affects the other comprehensive income, and how it affects the election that we have to take. There's a question, why would anyone choose unrealized basis? Okay, there is no need to choose it, right? If you don't make any election, it will become automatic. That is like a no election. This is actually the election. We have to make an election. If we say no, then it goes to the unrealized basis. So I think there is one more. Impairment of investment in subsidiaries, IFRS 5. So basically the impairment is dealt with IAS 36. Then if a subsidiary itself is held for sale, if a entire subsidiary is held for sale, it will come under IFRS 5. So that is how the difference comes. We'll have another question. I think that is based on the realization election.
I'm just reading out the question for the people who are driving. What is the impact if taxpayer elects to tax gain or losses on realization basis election under UAE corporate tax law? Option A, defer tax payments until income is actually received. B, recognize income and gains only when they are realized. C, avoid paying taxes on capital gains. D, use IFRS accounting principles instead of tax rules. What is the impact if taxpayer elects to tax gain or losses on realization basis election under UAE tax law?
mixed answers are coming, right?
Yeah.
B is the answer, because what is the objective is that we can have to recognize the income and gain only when they're actually realized, right? So because deferred tax payment is the effect of that. So the objective, if you read this law, the objective is not to defer the tax payment. Actually, it is one of that can be also right, but the correct objective, if you read the law, is like we don't want to tax the incomes until they are actually realized. The income or losses needs to be taxed only when they are actually realized. Right. Now let us move on. So now, as we discuss the various impact, so let us go to some of the specific standards and deals with the aspect that is covered under a standard, and we have to see, or we have to ensure that we are correctly valuing and measuring the respective asset based on the standards. And we will just also see a few example, especially from the point of view how it affects the corporate tax law or calculation of the taxable income. So these are the standards that we are going to cover. We will touch upon IAS 16, property, plant, equipment, intangible asset, impairment, investment property, non-current asset held for sale, and the inventories, agriculture, and the borrowing costs. So these are the main standard which affect the asset and the valuation. So we will just touch upon that standard. So let us start with the first one, which is the property, plant, and equipment, right? So what are the property, plant, equipment? As we say, the classification of the asset is based on the nature of the asset. So if you are holding an asset for the purpose of our business, which are either used in production or supply of goods or rental to others or administrative purposes, that will be considered to be our property, plant, equipment. We have a machinery, we have an office building, we have office furniture, we have vehicles, all that we are used for the production or supply of goods or services, or for our own purposes, that will fall under the property, plant, and equipment, and even that will be classified and that is considered to be as a tangible asset. Also, we should have expectation to use it for more than one accounting period. Here also we have the recognition criteria. So almost all the assets have the same recognition criteria. We should have it is probable that we should receive future economic benefit from the use of the asset, and as well as the cost can be measured reliably, right? So here if you see, it doesn't match with what is the definition under the conceptual framework, because the conceptual framework we use the potential word, right? Because these standards were old, and once the conceptual framework has been recently revised in 2018, that time they didn't they want to revise the standard, but they didn't revise the standard. But as you know, all these standards are under revision at a different points of time. So what the IASB's intention is that let us keep those points there as a recognition criteria, but later when they amend the standard or then they revise the standard, they will change this. That is why that is not exactly reflect. So it appears to an anomaly, like if you go to the conceptual framework, it uses a different definition, but still the probable future economic benefit is retained in most of the standards, so that we have to wait until the full standard gets amended. So this is where we have to measure the cost. So how we measure it? So if we see any property, plant, and equipment, the measurement at recognition is always at cost. After recognition, subsequent measurement, we can use either cost model or revaluation model, which is basically an accounting choice that we have to see. So what should be the cost? That is one of the areas that we have to consider when we are recording an asset initially. What all have to be included as the cost of the asset? So basically, it includes all the cost of purchase of the asset, all the cost that is directly attributable to bringing the asset into the current location and condition. All those costs is part of the cost of the asset, right? So we'll have whatever price we paid, whatever taxes we have paid, except that is recoverable, on which we can claim input tax. Any discount, rebates that we got, that comprise the purchase price, so that we have to include as part of the cost of the asset. And apart from that, whatever cost that we have to incur to bring the asset to our location, so we have to bring it to our place of business, as well as we have to make the asset to a condition for making it ready for our intended use. All those expenses until the asset is ready for the actual use, that is part of the cost of the asset. We have the site preparation, we have initial delivery, installation, testing, trial run, all the professional fees, all those expenses that we have incurred, which is especially related to the asset until the asset becomes ready for use, that should form part of the cost of the asset. So this have to be capitalized, and this should have to be considered as the cost of the, this should be included as part of the cost of the asset. So anything until the asset is ready for use, whatever cost we have to incur to make the asset, which is directly related to bringing the asset to its condition, that is part of the cost of the asset. In addition to that, if we have in future, we have to decommission the asset, or we have to take out the asset, any cost that we have to incur, that should also be part of the cost of the asset, and that have to be capitalized when we initially recognize the asset. Maybe we are installing an asset now, and that asset needs to be decommissioned, or the asset needs to be taken out after maybe 10 years or 15 years, or maybe after 40 years after the respective useful life. So whatever cost that we have to incur have to be included as part of the cost of the asset. So what we have to do is that maybe this we have to incur at future date. We have to see what is the useful life of the asset, then only we have to remove the asset. But in that case, what we have to take is take the present value of that dismantling cost and include it as part of the asset. The other one, we are not paying it now, so it will go to other standard, which is IAS 37, where we account it as a provision, and that account we have to increase the provision to, or we have to unwind the discount, which will go to the interest in the profit and loss account. So that is how the decommissioning cost needs to be capitalized. Any borrowing cost, if we have incurred, subject to satisfaction of IAS 23 condition, which is directly attributable to the construction or purchase of an asset, if it is a qualifying asset, should also be part of the cost of the asset, and subject to the condition of IAS 23, it should be part of the cost of the asset. See some question. So is a trial run included in the cost? Yes, trial run expenses are included in the cost. What about forex gain or loss? So usually there is no forex gain or loss, right? The forex gain or loss will come under the payable. So when we purchase an asset, even if we purchase an asset in foreign currency, we will record it based on the conversion. There is no exchange gain or loss will not come, right? Because we are recording the transaction on the based on the exchange rate on the date of transaction. So there is no forex gain or loss that comes to the asset. And once the asset is capitalized, we don't revalue it because it is a non-monetary item. Only for monetary item like receivable, payables, we will account for the foreign exchange gain or loss. For the asset, we will not. We don't have to revalue it even if there is a change in the exchange. That is a non-monetary item. Right? I think, Balram, we will take the question here one by one or later, how we want to do it.
I think, yeah, it's better we continue with the flow.
Okay, and then we will take a pause and then take it. Okay, no issue. I think because some questions are related to the intangible asset, right? So we are anyway going to discuss that. So once if we don't answer it in any time, we can take it up later. Okay, that is fine.
Yeah, we request you to put your questions at the end.
Yeah, you can put the question. We will take a pause in between and take it to good. Maybe once we finish few standard, we can see the question and answer that. Like that we can.
Okay. All right.
So that is included in the cost of the asset. So until the asset is ready for your intended use, and if it is directly related to the to make the asset ready for use, that can be capitalized. But there are certain exclusion. We cannot capitalize some expenses if it is a general or administration overheads, which is usually an allocation of the overhead. We have different department. So one department is doing the construction. So we just allocate the cost. It is only a book entry. So that cannot be capitalized. If we have constructed the building, any expenses that we incur for the promotion or opening of a new facility, we have had a grand inauguration function, so that is for the opening of the factory, that cannot be capitalized. If we have the operating losses initially, that can also not be capitalized. Any training that we have to give to the staff, like if it is a new asset, we have to train the staff to use it, but unfortunately that is not directly attributable to the asset, so that cannot be capitalized. Any abnormal wastage during the construction, we cannot capitalize. Any internal profits, so that usually happens. The same organization is constructing. We have a construction department, they construct the asset and transfer it to the other department. So maybe usually internally they will add a profit, but even if we add the profit, the internal profit cannot be capitalized because it is just profit for one department and the cost for other, but that cannot be capitalized as part of the cost of the asset. So this we have to be very careful, because as we say, this, as I mentioned earlier, this is very relevant from the corporate tax point of view as well, because if you see that corporate tax law says that, or even the GAID also refer to some of the clear example relating to some pre-operative expenses and all that. So whether before operating that we can pre-operative expenses or pre-incorporation expenses we can take it as the expenditure or not. So there also they give the clear answer, says that if it is permitted by the IFRS to be taken to the income statement, they will allow it as an expenditure. But IFRS says it have to be capitalized. It have to be capitalized. So that will not be allowed as an expenditure for the purpose of the corporate tax as well. Any subsequent cost, usually if we incur, so once the asset is capitalized, the asset we started using the asset, and then any cost that we incur can be capitalized. So that based on the general principle that if whether that subsequent cost increase the future economic benefit, in that case we have to capitalize it and add with the cost of the asset. If no, it have to be charged to the profit and loss account. So usually general rule is that we can capitalize all expenses until the asset is ready for its use. Once we started using the asset and when we started charging depreciation, any further cost we incur, can we capitalize it? The answer is yes. It depends upon whether it gives the future economic benefit. So accordingly, if we have to involve some major inspection, or we may have to replace some of the major part, or we have to do a major modification, that should have to be capitalized. In fact, this inspection and the replacement, usually we follow a component approach wherein we charge depreciation based on the components. Usually if we have to do, say for example, aircraft or ships have to do the inspection during a particular intervals. So what we have to do is that inspection cost should be capitalized, and that will be maybe every 3 years we have to do the inspection. So that inspection cost will be capitalized and we will charge as depreciation for 3 years, and subsequent inspection cost we will again capitalize, because without doing the inspection or without incurring the cost on inspection, we cannot continue with the asset. So it will increase the future economic benefit of the asset. To that extent, we can capitalize the subsequent cost. Any other expenses, which is for general maintenance or even the replacement of the small parts or anything which does not increase the future value of the asset, or which does not give much future benefit from the use of the asset, that cannot be capitalized. It have to go to the profit and loss account. Once we record the asset, we'll have to subsequently measure it. So as we say, we have two choices. It is purely an accounting choice. We can use cost model, or we can even use the revaluation model. So under the cost model, as we say, we take the asset at cost, we deduct accumulated depreciation, we deduct accumulated impairment loss, that will give us the carrying amount of the asset. If we have to use the revaluation model, we will restate the asset at the fair value. Still, we can charge depreciation on the increased amount. Since we can reduce the, if there is an impairment, we can reduce the impairment loss. Usually, we have to determine the fair value, and especially with respect to the market value, we have to obtain the market value or fair value of the asset. And usually, if we know the fair value, or if there are frequent fluctuation, we can do the revaluation every year, or even the standard suggests we have to do it in once in 3 to 5 years. There is one more thing, is that if we have to revalue a class, if we have decided to adopt revaluation, we cannot do it on individual asset basis. If we decide to revalue, that applies to a class of the asset. So usually we have classes, the standard itself, property, plant, and equipment. Property is one class. If we are deciding to revalue the building, we have to use the revaluation model for all the buildings, irrespective of that. If we want to use the revaluation model to the plant, we have to do it for all the plants. So we cannot say that, okay, I will revalue one plant and leave the other two plants on the cost model. No, that is not allowed. If we have to revalue, it have to be done on the entire class of the asset. So how we account for the revaluation? If there is an increase and we are increasing the value of the asset, so an increase in the fair value will obviously go to the other comprehensive income. But on the other hand, if there is a decrease in the fair value, the decrease will go directly to the profit and loss account. But that is for the initial one. If you do a subsequent revaluation, if we initially have an increase and subsequently again we are moving an increase in revaluation, or if we are doing an upward revaluation, again the gain will go to the other comprehensive income. But initially we have an increase and we have a gain in the other comprehensive income. Subsequently we are doing a downward revaluation. The loss does not directly go to the profit and loss account. First we have to adjust again whatever loss is there in the other comprehensive income. The balance loss will go to the profit and loss account. The same is the other case also. Initially, we have a downward revaluation. The loss have taken to the profit and loss account. Again, if we downward, subsequent losses will go to the profit and loss account. But subsequently, if we do an upward revaluation, first we have to set off the loss that we have already charged to the profit and loss account. Then balance gain only will go to the other comprehensive income. If we have a gain, whatever is a revaluation surplus, will sit in the other comprehensive income that cannot be reclassified to the profit and loss account until even if at the time of disposal of the asset. Once the asset is disposed, it will be transferred directly to the retained earnings. There is also an alternative accounting practice. We can keep the revaluation gain in other comprehensive income until actually we sell the asset, or there is another accounting practice wherein every year we can transfer a portion of the revaluation in the other comprehensive income, the retained earnings, over the useful life of the asset. Normally, the logic applied is that we will see what is the extent of depreciation that we have to charge, or additional depreciation we have to charge based on revaluation. To that extent, we can transfer every year from revaluation in the OCA to the retained earnings, but it will never touch the profit and loss account. That is again an accounting choice that we have to see. So automatically, whenever we have gone for the revaluation model, the gain or loss will go to the other comprehensive income. So here we have to remember, if we have taken the election under the corporate tax law, we need not have to tax these gain or loss. If the gain is sitting in the other comprehensive income, we don't have to do any adjustment. But if there is a loss that is in the profit and loss account, we have to do the adjustment, because we are not going to offer the loss at the moment. We have to offer the loss only when actually we sell the asset. In the same way, if we have a increase in the revaluation, or if we have increased the value of the asset and we have elected to tax that gain only on the realization basis, any depreciation that we charge will not be allowed as a deduction until and unless we reach back to the original cost of the asset if there is no revaluation of the asset. To that extent, the depreciation will also not be allowed with respect to those assets. So these are the other impacts on account of the revaluation wherein the tax will get affected. Then we have to charge depreciation. That is what we charge whenever we depreciate. If it is at the cost model, we have to charge depreciation based on the cost. If it is a revaluation model, we have to take the depreciation based on the revalued amount. So depreciation is always recognized in the profit and loss account. Basically, it is nothing other than we have to see what is the useful life of the asset. We allocate the cost or the fair value based on the useful life of the asset. Also, the residual value that we are considering and the useful life needs to be reviewed every time. And the depreciation will start when the asset is available for use, and is actually when it is not when it actually we use for the production, because the moment where the capitalization stop, we have to start depreciation. We don't have to wait until we actually start using the asset. Whenever the asset is available for use, we have to start charging depreciation. We can use, there are different methods of depreciation. Basically, it have to reflect the pattern of the consumption of the asset. That is why the standard specifically prohibits. You cannot depreciate asset based on the revenue that is generated from that particular asset, because it violates the principle. Depreciation is based on how we use the asset and not how we sell the product based on the income generated from that particular asset. Also, as we say, we'll use the standard gives an importance with respect to the component approach of depreciation. If we have bigger asset like an aircraft and each of the item have a different useful life, we will split that into the components, and based on the component approach we will charge depreciation. So we'll have one aircraft, we will not depreciate it for 20 years, rather we will see each part. Maybe the main component have a life of 20 years, another component engine will have a life of 10 years. So we depreciate engine for 10 years and the main body for 20 years. And accordingly, whenever it has to be replaced, we will charge the depreciation on that basis. The similar thing applies if we have to incur any overall expenses or any inspection that we have to do regularly. That also is accounted as a separate component. And based on the period for which we have to do the inspection, we will charge the depreciation on that particular portion. Then finally, the last part is accounting for depreciation. Accounting for derecognition. When we derecognize the asset on the actual sale of the asset, or whenever there is no further economic benefit is expected from its use, we have to derecognize the asset. So the disposal is the actual sale wherein we sell it. The second case is that the asset we cannot use it, so that will also we have to derecognize the asset. Whenever we derecognize, that is the actual realization happen. Whenever we sell the asset, the actual whatever is the sale proceeds that we have minus any gain or any book value or the carrying amount that we have will be a gain or loss, will actually go to our income statement, and the whatever gain cannot be classified as the revenue. So the gain or loss is not part of the revenue as per IFRS 15. It's a gain that goes to the income statement. So if we have opted for the election under the corporate tax, what happens is that whatever gain that we have not previously taxed will actually get taxed whenever we actually sell the asset, and any depreciation that we have not claimed earlier, that we can claim whenever we actually sell the asset. So automatically whatever gain is not taxed, the depreciation not claimed, we can claim in the year in the sale happen, and whatever is the difference amount will only get taxed whenever we actually sell the asset based on what is the profit or loss that we have taken to the income statement. An error there. Actually, we have a question, but unfortunately the answer is already there. So there is an error in the, I think, that animation. I did no issue. Anyway, we can discuss it. Like property, plant, equipment requires an asset that which has measured at original cost and recognition financial statement. Among the below item, which of the expenditure cannot be capitalized? So first one is clearance of site prior to commencement, that we can capitalize. Professional surveyor fees for managing the construction work, that we can capitalize. Entity's own staff wages for time spent, that we can capitalize. A proportion of administration cost based on the staff time, that we cannot capitalize because it is only an allocation, right? And if with respect to the professional fees, or if we link it with corporate tax, I think even the tax gate gives an example. If you use a professional and that happens to be a related party, if you pay any professional fees to that related party, and if it is not at arm's length, the difference amount, or which is not at arm's length, even though we have capitalized the professional fees, to that extent, depreciation will not be allowed as a deduction. So that is one more thing that we have to see. If we value the asset, if we use a professional, if it's a related party, that also we have to check at the time when we capitalize the cost, because it will impact the corporate tax and the arm's length principle there. Now, if we go to the intangible asset, so if we see IAS 16 and IAS 38, the accounting is exactly the same, because we have already seen the flow of the asset. We have initial measurement, initial recognition and measurement, subsequent measurement. Then comes the cost or revaluation model, depreciation. All those things will exactly remain the same, but there should be a bit difference based on the nature of the asset, right? Because tangible asset are tangible, we can see the machinery, furniture, equipment, vehicles, everything. Intangible asset is the one which does not have any physical substance. To that extent, some changes are there with respect to the recognition as well as with respect to the valuation or using the revaluation model. Otherwise, the accounting is exactly the same. So what are intangible asset? So intangible asset is an asset actually held for producing or supplying goods or providing services. But only thing is that it is an identifiable non-monetary asset which does not have any physical substance. So that is where the first part comes into the picture, or the important aspect is identifiability. If we cannot identify, because there is no question of identifiability for a tangible asset, it is directly we can see, and there we have a building, we have a machinery. But with respect to the intangible asset, the identifiability is very, very important. So if we have to satisfy the definition of the asset, it should be identifiable as well. So asset, we know we have the recognition criteria, we should have the control, future economic benefit and cost. All those things will be there. How we say that an asset is identifiable? So usually it is identifiable means the one thing is that it should be separable. Separable means we can sell that separately without disposing any part of the business. So what it means, like if we have a brand, sometimes what happens is that we cannot sell the brand alone. If we sell the brand, it is as if we are selling our entire business. Or we have a license. Can we sell the license separately? We can sell the license and still continue with the business. That is a separable asset. But if we sell the license, along with that we are selling our business, that is not a separate intangible asset. That type of an intangible asset we cannot record in our books of account. Usually the standard call it as internally generated intangible asset, so that we cannot record in our financial statement. And definitely it should be subject to contractual or legal right. So we should have a contract which gives the right. So we have a patent, so it should be subject to a contract, or we have a legal right. So we should have taken a protection, or we have taken a brand and that we have taken a patent on that. So it should be subject to any legal. If you don't have any, it cannot be separate, or we don't have any legal right, it will not fall under the identifiable category. Even though we have an asset, we cannot record it as an intangible asset. And definitely we should have control. The other recognition criteria with respect to the asset in the form of probable future benefit and the cost measurement should equally be satisfied in the case of an intangible asset. That is why we can just take few examples here. If we have human asset, it is not considered to be as an intangible asset, because we are value, because in most of the organization, especially in our audit and consultancy, the main asset is the human, but we cannot record that as an asset. Why? Because the thing is that though we have a contractual right, we have a contractual right only with respect to their performance. We cannot control it. So we cannot make a contract say that you have to stay permanently with our organization. No, we don't have any control. So it is beyond the control. So that is why it is not recognized as an intangible asset. Any recipes, formulas that we have, like unless we took a patent on that, we don't have a control. So that will not be recognized as an intangible asset. Usually if we have a market share or a customer royalty, we don't have exactly the control, or we don't have any contractual right, that we cannot take as an intangible asset. But if it's a customer relationship, that we can recognize subject to the condition. If we develop a software internally, yes, that is again subject to condition. If we purchase a software, definitely it's an intangible asset. If we have any rights that we took, like a license or a broadcasting right, definitely it's an intangible asset. But like we have a brand ambassador, so we are paying a fees, that is not an intangible asset. The same thing, we have a contract, but there is no control over that. If we have any operating system that is for the particular hardware, like the MS Office and all that, which we cannot separate from the particular hardware and software, we cannot separate, then again it is not an intangible asset, because the main component is the asset. We have a laptop. Laptop does not work without Windows. So in that case, Windows is not a software. But if you have a software like an accounting package, any ERPs that will work in any system, that will be considered to be as a intangible asset. How we recognize it? So basically, there are three categories of the intangible asset. One is a case where we purchase an intangible asset, we purchase a license, we purchase a trademark, or we obtain some right. For that, the normal asset recognition criteria will apply. We have to record or recognize the same at cost. That should be measured at purchase price plus taxes, duties, any directly attributable cost plus professional fees. Whatever we have discussed under IAS 16 will equally apply here. There is another category which we call as an internally developed. So we ourselves develop an intangible asset. Maybe we have a research and development project. We are a pharmaceutical company. We are developing the medicines, or we are developing an in-house software. We are a software company, or we are doing some internal innovation. All these internally developed intangible asset, the general category is that we cannot recognize the same as an asset. We have to always expense to the profit and loss account. But there is certain conditions that this we have follow for the development expenditure. If that condition is satisfied, we can record that as an asset. Otherwise, we have to take that to the profit and loss. There is another type of intangible asset. Usually we acquire in the business combination. When we acquire a business, there is a merger and acquisition wherein we acquire some of the intangible asset. So that intangible asset we can record. So usually that have to be recorded at the fair value on the acquisition date, and usually that can be have to be recognized separately from the goodwill. So here we can record an intangible asset if it satisfies the recognition criteria, even if the entity that which we are going to acquire have not recorded that in their books of account, still we can account for the same. How the subsequent measurement? The same model, cost model and revaluation model, but here we have a caution here. In the case of tangible asset, it is an accounting choice. We can use cost or revaluation model, but here there is a caveat. We can use the revaluation model only if an active market exists for our intangible asset. We can sell that intangible asset in any market, then only we can use the revaluation model. So all the IFRS 13 conditions have to be there. In most of the cases, if we are not able to sell our asset in an active market, then we are not supposed to use the revaluation model. So generally, for all those assets which are not have a market, but usually sometimes, like some example is that if we have a right like an operating or broadcasting right, that we can sell it to someone else that is traded in the market, because some of these intangible assets are traded in the commodity exchange. Those items which have a market, that we can only use the revaluation model. Otherwise, the generally used model for intangible asset is mostly the cost model. Then comes, as we say, the research and development expenditure. Usually this is one of the items. If we incur any research expenditure, there is no way that we can capitalize that research expenditure. Always any expenditure incurred with respect to the research have to go to the income statement. Only thing is that if we incur any development expenditure, we are developing a product, we can capitalize it subject to some condition, and the standard is very strict on the condition. We should have to ensure that that project is technically feasible. We have the ability to use or sell that asset. That have to generate the future economic benefit. We can measure the expenditure. We can have the intention to use or sell the asset. We have the resources as well as the finance available to complete the project. In most of the cases, the standard clearly says that some expenditure cannot be capitalized. It always have to go to the income statement, like expenditure on the research. So only exception is that if we are acquiring an entity, they already have a research expenditure that we can capitalize. Otherwise, the research expenditure can never be capitalized. Startup cost, if it is not part of the PPE, legal cost for establishing an entity, pre-opening cost, pre-operating cost, all these costs are not allowed to be capitalized. So automatically it have to be taken into the income statement. Why this is mentioned here? Because this is even discussed in the corporate tax law as well. Because what they say is that if you incur any pre-operating or any pre-operating expenses, all these things are taken to the income statement or is allowable as an expenditure subject to the condition referred to under the respective accounting standard. Here the standard clearly says that it cannot be capitalized. The same way, if we incur any training or even if we have an advertising or promotional activity, that cannot be capitalized, or even we have to relocate our office or reorganization, all those things can never be capitalized. So this is one of the place where IAS 38 clearly says that these are the expenses which can never be capitalized. The accounting standard says which can never be capitalized. That means automatically it is a revenue expenditure, and unless subject to the other conditions of the tax law, it should be an allowable expenditure as well. We amortize the intangible asset, but here also there is a portion. Only we can amortize those intangible assets which have a finite useful life. Usually, the useful life is determined by the contractual or legal right. And normally, in the case of tangible asset, we have a residual value. Here, we don't have any residual value. So we can amortize an intangible asset only if it has a finite useful life. What happens if it doesn't have a finite useful life? So that means we don't know what is a useful life. We cannot say it is 10 years or 5 years or any number of years. So automatically that falls under the category of an indefinite useful life. So we cannot amortize the same. That is always only subject to annual impairment review. We cannot take that as for amortization. That is what we have to see. Right. We can skip the question for now. Next is investment property, right? So what is investment property? So if we have any land and building, or land or building, or both, which is held to earn rentals or for capital appreciation or for both the purposes, we are not using it for production of goods or services or administrative, or not even held in for the sale in the ordinary course of business, they are classified as investment property under IAS 40. Usually, if we have any land which we held, we just bought the land, we are just holding it. Okay, whenever the price increase, we sell it. Or we have a land, we don't know what we are going to do with that. That also is an investment property. We have leased a building, and that building is also an investment property. If we have a vacant building and which is held to be leased out, that also is also an investment property. We have a land or a property which we are developing as an investment property, that also is an investment property. But if we are holding any property to be sold in the ordinary course of business, that will become inventory. That is not an investment property. If you're occupying the property in our business, or we are using that property for the purpose of our business, that is not an investment property. That will fall under the IAS 16, which is property, plant, equipment. If we are holding for future owner occupation, now it is vacant, but we say that, okay, no, we will shift the office to that building from next year. So again, we are going to use it. If we have given some buildings on employees for rent, it is occupied by the employee. Still, it is on rent, but our intention is not to get rent from the employees, though we are charging. That also is not an investment property. We have a property which we are going to dispose it. That also is not investment property. If we have leased to another entity under a finance lease, that also is not an investment property. Sometimes we have a dual purpose, right? We have a building, a portion is occupied as our office and another portion is given on rent. So in that case, we have to split it. The portion which we are holding will be considered to be as a property, plant, and equipment. The property which we are given on rent or held for capital appreciation will be an investment property, and it will go on that basis, right? So if, as we say, if we are holding it for future occupation, it is still a PPE. If you are going to sell it, it will be an inventory. If we have to hold it for a future investment property, still it is an investment property. How we measure it? If it is owned, then it can be measured at cost, as same principle of IAS 16. If it is leased, and if the investment property is leased and we hold it as a right of use asset, then it should be measured at a right of use asset, and that the accounting will follow as per IFRS 16 as well. What is subsequent measurement? Subsequent measurement, we have two models. One is cost model or the fair value model. So is it similar to the revaluation model? As we said, it is not similar to the revaluation model, but cost model is similar to IAS 16. We measure at cost less accumulated depreciation and impairment loss. Usually it follows the historical cost. But we know that even if it is a cost model, we are supposed to disclose the fair value of the property. What is fair value model? Here also, we have to find out what is a fair value of the investment property. We have to revalue that at the fair value. But what is the difference? Any changes in the fair value should always goes to the profit and loss account. If it is an investment property, nothing will affect the other comprehensive income. The gain or loss will automatically go to the profit and loss account. Another thing is that no depreciation have to be charged on if we use the fair value model on the investment product. That is different from that is why we say that it is different from the revaluation model. And one interesting thing this which came today is that if you know that if we use fair value model for a land and investment property, the IFRS doesn't allow to charge depreciation. If you have elected for realization basis, we don't take the gain, and there is obviously no depreciation, but the ministerial decision says that we are allowed to take depreciation based on some calculation. That is one of the changes that have come, which has just come in the afternoon only. So, but the point here is that why they are saying is that to bring the equality, because if someone is following the cost model, they can charge depreciation. Someone is following the fair value model, there is no depreciation, but the tax laws are those allows to take the depreciation on that. Okay. So that is important thing. So fair value model is different from the revaluation model. The gain or loss always goes to the profit and loss account. No depreciation is charged. As we say, there is one more thing with the investment property. If we change the purpose, we have to change the standard as well, right? So as of now, we are holding as an investment property. Maybe later we decide that, okay, this building, we are going to sell it and we are part of our real estate business. So it have to be converted to inventory. So whatever is the fair value, that will be, whatever is a fair value will be considered to be as the cost of the inventory, and we move it to the inventory. Already we have an asset which we own that we need to convert to the investment property. So in that case here, first we have to revalue as per IAS 16 because it is already held under IAS 16. Take the revaluation. Remember, if you revalue as per IAS 16, the gain or loss will go to the other comprehensive income. Then we will move as an investment property. Already it is an investment property. We can convert it to owner occupied property. First revalue under IAS 40, take the gain or loss, whatever is the income statement, and transfer it. Maybe inventory, we have to transfer it because we thought that we will sell that flat, but we want to use it for our own rental purposes. So we move from inventory to investment property. There also we have to first remeasure the inventory, and then any difference will go to the profit and loss account, right? So that is where other changes come with respect to the investment property. This is just a comparison of the revaluation difference between IAS 16, 38, and 40. Just we have discussed it. So you can go through that. I'm not spending the time on that. Let us take some examples here based on the three main standards that we have discussed. So this is basically linked to the corporate tax election, or that what we are going to see. You see the example, it is ABC is registered in corporate tax and first tax period is January, December. Draft statement of profit and loss account have a profit of 3 million. The balance sheet has a plan and machinery at a carrying amount of 1.2 million on 1st January. The plan have a remaining useful life of 12 years. As the plan is of special nature, the market values on 1st January is valued at 1.8 million. Then they decide to adopt a revaluation model for the property from the beginning of the year, as it is expected that the market price shall fluctuate at least in every 2 to 3 years, as this type of machine is in high demand. Depreciation is provided based on the revalued amount. Compute the impact on taxable income if the entity have elected to take gain or loss on realization basis on all assets and liabilities, and no election have been made. So what is the impact? What is the gain actually? We have the carrying amount as 1.2 million, that is revalued at 1.8 million. The revaluation gain is 600,000. Where the gain will go? This is a plant and machinery. So we are revaluing as per IAS 16. So the gain or loss will go to the other comprehensive income. How we charge depreciation? So in the books, the carrying amount, the revalued is 1.8 million. The remaining useful life is 12 years. So depreciation will be 150,000, right? Now what happened is that how we affect the corporate tax. If we have elected to take into account on realization basis, what adjustment we have to make in respect to the gain? We don't have to do any adjustment with respect to the gain, because where the gain is sitting, the gain is in the other comprehensive income. It is not included in the 3 million net profit, right? But if we have not taken any election, do we have to make any adjustment? The answer is yes, because the 600,000 gain is in the other comprehensive income. And if we again read the ministerial decision, if we have any gain which is in the other comprehensive income, which is not subsequently reclassifiable, we have to offer for taxation. So that will be the impact. If we have not made any election, we have to take that 600,000 gain, which is sitting in other comprehensive income, and offer for tax, because you have not made any election, that we have to charge. So then in that case, any effect on depreciation, there is no effect on depreciation, because you have taken the gain, you have taxed the gain. So whatever is the depreciation that you have provided will be allowed. But what is the effect that if you have elected? So you don't have to make any adjustment, because the 600,000 has not affected your profit. 600,000 is in the other comprehensive income, but already you have made the election. So no need to do any adjustment. But this depreciation will be allowed. This depreciation will not be allowed, because depreciation to the extent when the asset bring back to the original cost, to that extent, depreciation will not be allowed. Still, we have 600 is a gain, or in other words, until the gain that we have recognized, to that extent, depreciation will not be allowed. So 150,000 depreciation will not be allowed. So if we make that, we have to add back 150,000. So that will be the impact on the taxable income on the basis of the revaluation as per IAS 16 and the election that we have made. Then we have another example. So that is based on the another thing. So it's the first line is the same. I use the same example. They have a land which was not at use by the entity, and the plan is to let out on getting good tenant. So obviously there's an investment property. The land and building is valued at fair value, and the fair value on 1st January was 2.8 million. The fair value of the same at the end of the year, 31st December, 3.2 million. So the entity uses fair value to measure the land. Same thing, we have to take the impact, right? So here also, what is the impact? It is 3.2 million and 2.8 million. So 400,000 is the gain. So remember, it's an investment property. So the gain is going to the income statement, right? So if we have not made any election, already we have a profit of 3 million. The 400,000 is included in the 3 million profit. So we don't have to make any adjustment, right? But if you have made the election, we have the 400,000 gain in the profit and loss account. So we are not going to pay tax now. We have to pay tax only when it is actually realized. So we have to take it back from our accounting, right? So that is the election. So if we don't make any election, 400,000 is already sitting in the 3 million. So it is already, we are offering for tax. We elect it, we have to take out 4 million, because it is a investment property, which is using the fair value. Always it goes to the income statement, right? Now let us see another part, because this also have an impact on the taxation. So you'll have the borrowing cost as per IAS 23. What happens here is that the question here, we have an interest cost. We are purchasing an asset or we are constructing an asset. We incur an interest cost. Can we charge it to the asset, or we have to take it to the profit and loss account? The rule is that any expenditure of interest that is related to the acquisition, construction, or production of a qualifying asset, we have to capitalize along with the cost of the asset, else it have to go to the profit and loss account. That is a general rule. What is a qualifying asset? Usually that is an asset which gets substantial period of time to get ready for intended use. We are manufacturing some plant, or maybe we are manufacturing a ship, or we are developing a real estate. It will take substantial period of time. What is substantial? It is again a management choice. There is some the 1 year, 2 years, or even some cases 6 months or shorter period will also be a substantial period. So if we feel that period of development or period of construction is substantial, that will be considered to be as a qualifying asset. What is a borrowing cost? Any interest and other cost will be considered to be as a borrowing cost. So interest on bank overdraft, any amortization of the cost, any finance charges, any exchange differences will all be considered to be as the borrowing cost, right? So what here? All those things have to be considered to be as a borrowing cost. And if it is a qualifying asset, we have to capitalize it. How we capitalize it? There is two concepts of specific borrowings and general borrowings. If we have taken a borrowing specifically to a particular asset, there it is specific. So whatever interest cost we incur, we directly capitalize. And if it is a general borrowing, means it is like a treasury department have taken the loan. We have so many assets. So we use a capitalization rate or weighted average rate and capitalize it. How we capitalize it? We have a beginning period. Whenever the expenditure start, we will capitalize. We'll stop capitalizing when it is substantially complete, and we have an interruption period as well. So whenever we incur the expenditure, when we incur the borrowing cost, whenever the activity is in progress, we'll capitalize it. Until when we capitalize, when the asset is ready for use, because IAS 16, whenever the asset is ready for use, any subsequent cost we cannot capitalize. In between, if we have any temporary suspension due to any technical delay, and if it is not our fault, then we can capitalize. But if it is due to another reason, we cannot capitalize. Fine. This is the standard. It's a simple standard. But is there any impact on this from the corporate tax point of view? The answer is yes, right? So corporate tax have a specific provision on the interest. It is subject to condition, EBITDA, 12 million rules are there. But still, if you have applied IAS 23 and have capitalized the interest a certain period to the asset, the tax laws doesn't allow it as interest, but the tax law doesn't allow, even though it is capitalized for the purpose of tax purposes, that we have to include as an interest. How we include as an interest? It is already charged as part of the cost of the asset. Fine. What goes to the profit and loss account from the asset is in the form of depreciation. So whatever is the portion of the interest capitalized with respect to the cost of the asset, the corresponding depreciation will not be treated as depreciation. It will be treated as interest, and that interest have to be added with the other interest to calculate that 12 million limit or to calculate that 30% of the EBITDA. So that we have to be, if you are using or if you are applying IAS 23, then we have to see how it affects the corporate tax rule. So based on this and the other thing, we have just a small example here, which covers all other aspects as well. Again, the condition is same. It is the same entity and same profit. What happens is that during the year, ABC LLC construct an additional building as an extension of the existing office. The construction was started at the beginning of the year and completed on 30th September. The cost incurred and capitalized during the year, land acquisition is 1 million, fee for environment and building permit is 500,000, 5 million. Then architect and engineer fees 100,000, construction material and labor cost 600. Interest capitalized as per IAS 23 is 36,000. So total cost capitalized is 2,236,000. The ABC have already charged depreciation for the building considering useful life of 20 years. It have taken a loan of 600,000 from Dubai Bank at an interest of 8%. These is only borrowings and which was specifically used for the construction purposes. As the period was considered substantial, the interest up to the date of completion of construction was capitalized as part of the cost of the asset. Fee for environment building permit include a penalty of 150,000 paid for non-compliance of environmental guidelines. Architecture fees includes 30,000 paid to the wife of the shareholders of ABC LLC, who is not an engineer. The similar amount payable to other architects is only at 10,000. So this is where both accounting standard and tax fight each other, right? Or
very interesting one, yeah.
Yeah. Here, what we have to do, how we calculate depreciation, because for accounting purposes, we have a total value of land and building at 2.236 million. 1 million is our land, we don't depreciate it. So 1.236 million is, so we will charge because it was capitalized on September. So October, November, December, 3 months depreciation, 15,450 will go to the profit and loss account. So can we take, so here there is no realization. We are not speaking about any gain or loss, but still the question, the entire depreciation of 15,450 will be allowed for tax purposes. The answer is no, right? Which is not allowed. The two things. One is that this building permit has a fine. So what the tax law, if it's a fine, it is not allowable. So we have capitalized it. So the proportionate. So this is actually calculated proportionate basis. So 15,450. So upon 150, because 150 is also included there. So also there is a transaction which is not at arm's length. So 30,000 is included. The arm's length price is 10. So difference is not at arm's length. So 2125 depreciation is not allowable. So when we calculate taxable income, 2125 will not be allowed as depreciation. Is there anything else? We have an interest capitalized at 36,000 as well, right? So what happens is that it is not considered as depreciation, but it is considered as interest. So to the depreciation to that extent. But here if we see, but we just assume, or here somewhere it is mentioned that these are the only borrowings, right? So it doesn't fall the 12 million criteria. I just made it simplified. So otherwise it should be more complicated, but practically it can happen. If we have any interest, this will not be treated as depreciation. So it will be taken out of depreciation and have to be added with the interest and will be considered as the net interest expenditure while calculating that 30% of EBITDA rule. It will go here. It is, we don't have to do any adjustment because anyway, that is an allowable expenditure, whether it is interest or depreciation, it doesn't falls under the interest limitation rule. So it is an allowable expenditure. So it will go on like that. I think why entire 30K should not be disallowed, right? Whatever is not within the arm's length will only be disallowed for the architect fees paid to the related party. There is no question. Only thing is that it should be at arm's length because it happens to be a related party. Right? So no need to disallow 30,000.
But I think since you mentioned she is not an engineer, maybe that is what is the question that they're asking.
Okay. I understand. Yeah. Okay. That way also, right? Yeah. Okay. But yeah.
You understand now.
Yeah, I understand. Yeah. So now we go to the impairment part, which is IAS 36, right? So usually the basic logic of IAS 36 is that the asset should have to be properly valued in the financial statement, right? Because why we have the asset, we have to get the future economic benefit. So always whatever value at which the asset is stated in our financial statement should be more than what we are going to expect, whatever should be more than what we are going to get from the asset. If we are taking the asset as what we are going to recover from the use, or either we have to use it or we have to sell it. If the value is not equal to that, we cannot carry asset at that value, because the objective of having the asset is to receive future economic benefit. So that is why we have the carrying amount and we have the concept of recoverable amount, what we can recover in future. Either if we are using the asset, how much we get, or we are selling it, how much we get. If our value is exceeds that amount, then it is not realistic to show that value. The difference we have to account it as an impairment loss. So it applies to property, plant and equipment, right of use asset, intangible, including goodwill, as well as investment in subsidiaries, associate and joint ventures, because other type of investments are covered under financial instruments. Automatically they have their impairment requirement. There are two types of impairment. So usually it is a trigger-based testing. It is not necessary that everywhere or every year we have to go and check for the impairment. We have to see that some red signals are there. Only if that happens, then only we can go for checking impairment. But in few cases, we should have an annual impairment testing to be done compulsorily, regardless of the fact that whether we have any indicators or not. First one is a goodwill that is acquired on business combination. So because that goodwill we will not amortize like any other intangible asset, that have to be checked for impairment every year. Intangible asset with indefinite useful life that we discuss when we discuss about the intangible. If we don't have a useful life, we don't amortize it. Rather, we have to check for impairment. Same way, if we have intangible asset not at available for use, usually which is under the development stage, that also have to be checked for impairment every year. In respect of other asset, we don't have to do this testing, but we have to do the testing if some indicators exist and based on the judgment of the management. So that is where the impairment step happen. We have to first check, except those subject to annual impairment testing, we have to assess, is there any indicators of impairment? If the answer is yes, we have to go and calculate what is your recoverable amount. And if carrying amount is more than the recoverable amount, we have to go for the next step. We'll account for the impairment loss. So that is the thing. If there is no indicator, we don't have to go to the next step. In the second step, we estimate the recoverable amount, and still the carrying amount is lower than the recoverable amount. We don't have to go to the third step because there is no impairment loss at all. What are the indicators? Usually the indicators are some red signals, like maybe the asset have damaged, or the asset have a technological issue, or the asset has a fall in the market value, or some restriction happens from the regulators that we cannot use the asset. So these are the indicators which trigger for the impairment. If that indicators are there, we have to go and calculate what is a recoverable amount, which is obviously the higher of value in use or the fair value less cost of disposal, because there are two things. Value in use is a value that we have to take, assuming that we are going to use the asset. So what we have to do is that we have to take the present value of the future cash flows expected from the use of the asset. But if the other option is that if we are not using it, we are going to sell it. So there we have to take what is a fair value less cost of disposal. So the fair value is as per IFRS 13, and we will see what is the higher of the amount. That will be the recoverable. If carrying amount is higher than the recoverable amount, the difference we account as an impairment loss. So basically, where we account for the impairment loss, it goes to the profit and loss account, provided for these asset like PPE, intangible asset, or any other asset, we are using the cost model, directly it go to the profit and loss account. If you are using a revaluation model and already we have a revaluation gain appearing in the other comprehensive income, then it will go to the other comprehensive income as well, right? So that is how we account. So we have to, except for these three assets, we have to check whether if we have any indicators like fall in the market value, technological changes, physical damage of the asset, then we have to go for the impairment testing, calculate the recoverable amount, difference will be accounted as an impairment gain or loss. Loss only, so there is no gain, obviously, sorry, it's only a loss that we have to account. Usually, the impairment is calculated for the individual asset, but sometimes what happens is that we don't have any cash flows from the individual asset. So that gives us to the concept of what we call as a cash generating unit. It is nothing other than a group of asset which gives the cash flow. Say we have a machinery, but that machinery is used along with other machinery to sell the product. So whenever we calculate the cash flow, we don't have a cash flow for a particular machinery. So a group of machine we took as a cash generating unit. It can be a product lines, a business, or a location. So that for that we have to calculate the impairment loss. Usually, whenever we calculate a cash generating unit, even a division can be a cash generating unit, and we have a goodwill. If we have acquired that particular division, we have a goodwill also part of that division. So definitely, we have to calculate the impairment loss as well. And one more thing is that if goodwill is already part of an asset or goodwill is already part of a cash generating unit, that same rule for goodwill applies. That cash generating unit have to be tested for impairment every year, right? So how we account for the impairment loss? Here we have to allocate the impairment loss. If we are calculating for individual asset, we'll reduce the value of the asset. But if we have a group of asset including goodwill, we have to first allocate it to the goodwill, then it allocate pro rata to the other asset, and any asset should be in such a way that it should not be more than the fair value. So that way we have to make the allocation with respect to the impairment loss. So impairment loss is not a permanent loss like depreciation. Subsequently, whenever the conditions or the factors change, we can reverse the impairment loss. So earlier we have the indicators. Now that indicators becomes good, like the market problems have changed or the regulatory restrictions have changed, we can reverse the impairment loss. So usually, if it is for the individual asset, we can reverse the impairment loss subject to the condition that whenever we increase the value of the asset, it should not go beyond the carrying amount, provided there was no impairment loss. And any adjustment should be made to the profit and loss account or the other comprehensive income. If it is a cash generating unit, we can allocate it to the asset, but we cannot reverse it to the goodwill because no reversal is allowed for the goodwill. That is what we account for the impairment. So if we have the impairment loss, that also if we have subject to unrealized gain or loss option, this is also one of the case where this is an unrealized loss actually. So we have to take it out for the tax purposes, and whenever we reverse it, obviously that we have to take it as income because anything which we have not offered, we have to take, and we will take it to consideration only when we have actually sold the asset and we receive in any actual gain or loss. An example, because we'll skip it considering the time, right? Because we have 15 minutes, right, Balram?
Yeah, that's right. Yeah.
Yeah, okay. We have only few small standard left, and we can take any questions specifically there.
Yes, yeah. Let us also buy.
Now, another place where this unrealized gain or loss come is the case where any non-current asset have to be classified as per IFRS 5 in the form of any asset held for sale, right? So if we have, that is the first question asked because already we told that the category of the asset change based on the purpose of holding. If you are not holding any asset for sale, we'll continue to apply the standard, whether it is PPE or whether it is intangible asset or investment property. But the moment, if any asset we have decided to sell it, we have to apply the IFRS 5. Actually, IFRS 5 deals with two things. One is on the individual non-current asset, which we have decided to sell. Also, it speaks about the disposal group or a component of the entity that we have already decided to sell, which is a mere classification. We have to classify the sale as discontinued operation, right? So that is the two parts of the standard. I think we are not going to the discontinued operation because it is only a disclosure part. So basically what we are going to discuss here only, whenever we have a non-current asset and that we have decided to sell it, then what we have to see or how we have to make the accounting for the sale. So whenever we say that we have decided to sell an asset, it is not a mere decision. And the standard is very strict in that. We cannot simply that, okay, let us sell the asset. We should not have to simply say that. It should be substantiated with some condition. And the standard speaks about a classification can be done only if the tests are met, and it is usually called by the standard as a highly probable test, right? So the first condition is that the asset should be available for sale immediately in the present condition, and the sale should be highly probable. The management should have all the evidence that they have a definite plan to sell, and they are actively seeking for a buyer to purchase the same. Usually, the sale is expected to be completed within a period of 1 year, but there are certain exceptions. If due to exceptional situation, if we cannot complete the sale, we cannot. And also, we don't expect any significant changes in the value of the asset. How we account for the change? Usually, before we classify, we will see we have to first account for the impairment of that particular asset. Either we follow IAS 36 or we follow IFRS 9, depending upon the category. Then the impairment loss have to be first accounted into the profit and loss account or OCA as per IAS 36. So there are two accounting. Once we decide we have a non-current asset to be sold, first we have to use IAS 36 and check for impairment and account for the impairment loss. Then once we have classified it as to the asset held for sale, we have to value it as IFRS 5, which is either the lower of carrying amount or fair value less cost to sell. The adjusted carrying amount minus fair value is an impairment, which always goes to the profit and loss account, right? Once we classify this as held for sale, then it is no longer depreciate or amortize. So we don't have any depreciation or amortize, but the gain or loss will automatically, or the unrealized gain or the impairment loss will go to the profit and loss account, right? So we cannot overstate it. So always the loss will go to the profit and loss account. So here also, this is one of the case which falls under the option because we have not yet sold the asset, but we have accounted for an unrealized loss. And obviously, the standard have a strict period of 1 year, except that can be relaxed. But only thing is that if it falls under the 2 taxable period, then we have to make the election. And obviously, we take it out in the 1 period, and whenever within the next year, we should have obviously sold the asset. So unless there is a change in the plan, the standard also say we can change in the plan, we have to restate it. So that is any exceptional circumstances, this also will fall the category. So usually the other is a disclosure part. Once we have decided that an asset and liability is classified, we have to show it separately as a non-current asset held for sale or a liability. If it is associated, that also have to be classified as per that. If the question, we'll skip on it. Anyway, you will get. Now we have another asset, which is actually a current asset, which is inventory, right? So basically, the inventory also follows the same rule like any other asset, but except that it is a current asset and is already held for sale. So it should be held for sale or production or material supplies there. So it comprises a form of raw material, work in progress, or finished goods. Always, what is the principle of valuation? So as we generally know, the principle of valuation is always at cost or net realizable value, whichever is the lower. So cost is the cost to acquire the property. Basically, here also we follow the same IAS 16 principle. Whatever is the cost, then realizable value is the price that we can get. So usually we have to measure at cost and the initial measurement, and until each subsequent reporting period, we have to measure it. Usually we take it on individual item or group of similar item. We'll start with what is the cost of inventory. We determine the realizable value. We compare the cost and the realizable value. What are the cost of inventory? So usually inventory is purchase cost plus conversion cost, because if it is a trading organization, we will have only purchase cost because we are buying the same goods and selling it. But if we have any we are manufacturing, we'll have the conversion cost as well. So purchase cost is purchase price plus expenses incurred to bring the inventory to the price. Conversion cost is actually the cost of converting raw material into the finished goods, which includes the direct labor, allocation of overheads, and the variable and fixed production overhead. Similar way, some costs are excluded. We have abnormal waste of material, storage cost, administrative expenses, and selling cost is not part of the cost of the inventory. Net realizable value, as we know, is the estimated selling price minus estimated cost of completion, cost necessary to make the sale, and usually what we have to realize. And we know about the method of accounting it. Like we have historical cost method, which is either first in, first out, or weighted average, or even we may use the standard cost or adjusted selling price method. LIFO, last in, first out method is not permitted under IAS. Now come to the main part is usually the write-off down from the inventory to the cost. Usually what happens is that we follow the principle of cost or net realizable value, whichever is lower, which is basically based on the fundamental principle of a conservatism or prudent concept, because whenever usually we are going to sell it, that is why it is similarly an impairment as per IAS 36 that is already there for inventory. So we will see that whether whatever selling price or net amount that we are going to sell is more than what we are with our cost, fine, then we don't have to do any adjustment. But in exceptional circumstances, when the inventory becomes damaged or there is a decline in the market price or some other exceptional circumstances have happened, it may happen that the price that we are going to get when we sell it is lower than the price that we are, the cost. Immediately we have to write off the inventory. Usually the write-off will go to the profit and loss account. This also can be reversed, but subsequently the market improved. We have not yet sold the product. We can reverse the write down to the extent of the cost, right? So usually this also can be considered to be as an unrealized loss because we have not yet sold the inventory. So until and unless it is sold, this write-off will be considered to be as an unrealized loss item, right? So that is how we have to take inventory also. I think we have a question. I will skip it for the moment. We have one more section, which is agriculture. Here also the fair value and adjustment will come. Usually, what is agriculture? So usually we have IAS 38. It's a management of biological transformation of the asset. But basically, the asset covered are known as the biological asset, which may include any living elements, livestock, or living plant, or any agriculture produce after the point of the harvest. Usually, the first two, living animals and plant, are known as biological asset, and the agriculture produce are the products that we get from that particular thing. So usually, like if it is as an example, it's the sheep, the wool is agriculture product, and whatever we make from that is the further produce, right? So the valuation of the biological asset and the agriculture produce at the point of harvest is covered by IAS 41. Once we have the agriculture product after harvested, it is an inventory. So it would automatically go to IAS 2. One asset which is not covered is bearer plant, because that is covered as a property, plant, equipment. What is a bearer plant? So the best example is an apple tree or a rubber plantation. We will use that plant for the production or supply of goods, and that plant have to bear the produce maybe for more than one accounting year. We doesn't cut the plant unless, like if we have a rice plantation, we will cut the whenever we harvest it, that will go. We don't have the tree left, but here we'll have the tree left or the plant will left, but we use the plant to have a multiple production cycle. So it is similar to the machinery. That is why it is classified under IAS 16 bearer plant, right? So that will not considered as the. So here, what is the recognition criteria? The same. We have the control, we'll have the economic benefit. The measurement is slightly different. So there is no cost concept for the biological asset or agriculture produce. Always, whenever we initially recognize the asset, and for the subsequent measurement, always the measurement is at the fair value, right? And if fair, only exception is that if we cannot measure the fair value, then only it should be measured at cost. Whether we have any acquisition at the birth, like the animals are there, but harvest point, all the cases we will use the fair value. And where the fair value will go, the gain or loss will always go to the profit and loss account for the period. So that is another different approach of fair value, wherein the asset. So this is one exception wherein we don't recognize the asset at cost. We always use the fair value concept, and any gain or loss, whether we initially recognize the asset as well as whenever we subsequently sell the asset or each reporting day, we have to remeasure to the fair value, and then fair value gain or loss will go to the profit. And those industries which are related to this, even this fair value accounting will fall under the unrealized gain or loss category. So if we are the part of like any farm or dairy farm, we have to check how they have to opt for this with respect to the corporate tax. So because this is also part of that. I think that is all for today. I think we can take few questions. Anything which is there?
I think you can take few questions. They are there in the chat box. If you have more questions, you can definitely drop them. So the recent one from Mr. Mohammed Lakhani is, so if there is a revaluation of inventory to its NRV, then such impairment will be added to the taxable profits in case taxpayer has elected for taxation on realization for all assets and not if elected the capital asset only.
Yeah, okay, that is the second option, right? So if we have elected for all assets and liabilities, this impairment loss we have to add back. But if we have elected for only for capital item and not for revenue item, inventory is a revenue item. So obviously there is no need for any adjustment to be made.
Yeah, from Surinder Saranji, office building used by business is in the name of owner personal name, but not in the name of business name. How to treat in accounts and corporate tax?
That is a risky question, right? Because if it is not in the name of the business, obviously we have to use the control perspective, and maybe we can take it for accounting purposes, but for tax purposes, whether it is ownership and whether we get the corresponding expenses is a question that we have there, right? So it is obviously good that always it have to be re-registered or retransferred in the name of the business, and then only it's both from the tax point of view, because for accounting standard it goes by the control mostly, but I think tax people have to mostly go by the legal approach. There is not normally substance over form in the tax laws in most of the cases, right?
True. Yeah, it is risky then. So how is the, I think this is most relevant. How is the transitional rules as per Article 61 and MD 120 will impact the decision in the cost, revaluation and fair value method?
Yeah, because I think the transitional rule will apply only if we are following the cost model, right? So we have either immovable property or intangible asset, as well as the financial assets are there. So first of all, the transitional rule will apply only if historically you are using the historical cost model as per any of the standard. But if we were following any revaluation model or fair value model, the transitional provision will not be applicable, because already in your opening balance sheet or whatever is a balance sheet, you have applied revaluation model or fair value, so already matches with the market value on that particular date. So transitional provision will not be applicable. This relief is given, we are accounting for the asset at cost. Maybe we have purchased it some 40 years back. Now, if we are at any after tax comes in, when we sell it, we have huge gain if we have a land or something. So tax have the neutrality principle, right? They don't want to tax on the gain before you take it. That is the relevance of the transitional provision. That will not be applicable if you are following the revaluation. Hope that is the question, right? Or I answered the question.
There are a couple of questions on PPE.
Yeah.
We did not address that time. What should the date of capitalization of intangible assets like application development generated internally?
I think we discuss about the development expenditure, right? So development expenditure can be capitalized when all the conditions are satisfied. Like we have the technical feasibility, we have the financial ability to run the project, or we have the product have active market, we have the future economic benefit, and cost can be developed. Once the development is complete and the product we are marketable, and once the product is ready for use, or when we can start selling the product, at that is a point where we have to capitalize, or we have to capitalize the development expenditure. From development expenditure, then we can take into the intangible asset. That is the date whenever the project is up, and we can demonstrate that we can start selling the product, or we can get it is not necessary that we have started production, but at a point where we can demonstrate that it is ready for use, and at any point we can start selling and start generating revenue or future economic benefit we can capture.
I think it's more about the date from
Yeah, that is one of the interesting thing as per IAS 36. If we have this development expenditure, until and unless, because usually impairment applies to the asset already as an asset, but this development expenditure not yet capitalized, then every year we have to check for the impairment, because what happens is that we are accumulating the expenditure, but maybe this year we feel that okay, that product is marketable. Maybe next year it may happen that some restriction came and still the product may not be marketable. So then we have to check for the impairment. That is one will fall under the compulsory impairment every year.
Yeah. I think we have questions related to capitalization. What about due diligence cost? Whatever they have done on before construction for PPE, should it be capitalized?
Usually the thing is that if it is specifically for that asset or without conducting the due diligence, we cannot acquire that asset. It is directly attributable to the cost of the asset. So it can be capitalized. But it is just like we did a general market survey, which is feasible, which is not directly attributable. Or even if we don't do that, we can acquire or construct that asset. It may not fall under the definition of a directly attributable cost. So it may not be capitalized.
Yeah, if it is relevant, of course.
Yeah.
And further to that, VAT paid on capital goods also needs to be capitalized.
If we have a refundable VAT, we cannot capitalize, because non-refundable taxes only can be capitalized. If we can claim anyway, if we can claim input tax, it will not go to the asset, right? It will already go to the input VAT account or recoverable VAT account. So it cannot be capitalized.
Yeah. I think can initial production during the construction phase till commercial production starts, basis the requirement, can it be capitalized? Initial production during the construction.
question. Maybe they're saying the initial until, because the capitalization stop when the asset is ready for the use. It is not necessary that the actual production have to be done. We have done the trial and we commission it. Okay, the asset is ready for use. Maybe it may take 1 or 2 months for the actual production to happen, but it doesn't matter. We have to stop capitalization when the asset is ready for the commercial use. It is not necessary that we have to start the commercial production. It can happen later also, because that point the capitalization cease and depreciation trigger, because depreciation start from when the asset is available for use and not when we start using the asset. So that is the stop cutoff for the capitalization as well. I think, hope that is the question.
Yeah, I think one last question on PP. Internal team is involved in project development. Those costs are directly attributed.
Definitely. If we have, I think one of the example we discussed that also. Any cost of the internal staff can be attributed. Only thing is that we cannot add any profit. Like sometimes what happens is that we have a manpower department. They supply the labor to the same organization. Maybe they are charging the cost plus markup. The markup or the profit cannot be capitalized. Otherwise, our own expenditure directly involved in the production process is chargeable. But only thing is that, like, we have a manager, we are allocating the cost of the manager. That is an allocation of overheads that cannot be capitalized.
Yeah, I think we have an interesting question from the master himself. Neeraj is asking, if land was acquired in the past and was revalued in the past, now construction happens on the said land in 2025. So whether the actual cost or revalued amount of land would be allowed as deduction. If land was acquired in the past and was revalued, now construction is happening on that said land in 2025.
Okay.
The actual cost or revalued amount of the land would be allowed as deduction.
There is no deduction, right? It's anyway, land is not subject to depreciation. So if we have revalued the land, anyway, we are constructing building on the revalue, and whatever is the carrying amount of the land will be the revalued amount. When we construct the building, we will capitalize the cost of the building, and the building will be subject to depreciation. Land will not be subject to depreciation, right?
I think we're missing something on that. Neeraj, if you want to ask yourself, I think you can unmute and then ask.
Yes, thank you. I think my question, can you hear me?
Yeah. Go on.
Yeah. The question is in relation to the after the development, basically the person as a developer is going to sell the property. So on the property which are developed on the said land, it is sold. So how do we take the deduction for the cost?
Okay, the land is going to sell, right? Because usually if it is already revalued, the carrying amount should be the revalued amount. So because already we have taken the gain or loss in the gain in the past, right? And so when we have revalued the land, okay, now we are selling the land plus the building. So to calculate the cost is always the carrying amount, right? So how we calculate the cost on disposal is a sale proceeds minus the carrying amount, not the original cost. So if the land is revalued, the carrying amount is a revalued amount, because the definition of carried amount is the original cost less depreciation. If there is a revaluation, that is also part of that. So it should obviously be the carrying amount, which is a revalued amount. We don't have to go to the original cost.
Yeah. There's one more question from Jiran. If I have some office buildings in outskirts of RAK and also in prime location in Dubai, can I apply revaluation model to Dubai offices and cost model to RAK offices?
Because even if it is
the same class of assets,
no, it's building is same class. Whether it is in one location or whether it is used for different purposes, it doesn't matter. If you have to use revaluation model, we have to. If you are going for one, you have to apply for all the building, regardless of whether it is in prime location or whether that location doesn't have the revaluation. No, if you have to use it, the standard permit only for the class of the asset. You cannot revalue rack office, or you can revalue Dubai office, or cannot revalue rack office. That is not within the standard condition.
Yeah. So before everyone leaves, or leaves, thank you very much, Ranjit ji, for your valuable contribution. I think within these 2 hours, you've covered significant amount of IFRS standards relating to assets valuation, impairment, I think very clearly and neatly explained all the relevant provisions, as well as you also covered the areas related to corporate taxes of the realization basis elections areas while covering the IFRS. So I think definitely, I at least know I enjoyed your session thoroughly for 2 hours. I'm sure most of you. I think I can see that more than 200 members were there for entire 2 hours, which itself shows the
Yeah.
kind of contribution that you made as part of, through this session. Thank you very much once again for this.
Okay.
If there are any more questions, definitely I think we'll wait for some more time. I'll request Ranjan ji to wait for some more
Yeah,
time.
sure. No problem.
Thank you all for that.
Thank you.
Thank you
Thank you
all.
very much, Sanyu. Thank you, Balram, and thank you to the entire committee of the ICA Dubai to give me the opportunity to speak. And thank you for all the members for patiently listening, especially at the evening on a Thursday and on this hard topic on IFRS or even corporate tax, right? Now both are become equally relevant, right? It is like both sides of the same coin, right? Without IFRS, no tax. Without tax, that both have become complementing to each other, right? Especially like today's ministerial decision, it gives rise to another thing. We have to think of the deferred tax impact, because it is one area where IFRS doesn't allow depreciation if you revalued if you have a fair value for an land, but tax law says that you provide depreciation. So because we have only very limited item in deferred tax now, that may increase if they propose with the depreciation rate for other asset as well. Yeah.
Yeah. I think Gopala K. Raviji is asking about, hope you will cover IFRS 9 shares held.
I think why I didn't touch that one is time, and I think we had a detailed session in IFRS 9
Already we
last
covered.
month, right? So I
3
think
days we covered last time.
6 hour session is there. That is why we don't go there, because this we didn't cover earlier. That is why we thought of putting into the non-financial asset part. Yeah.
Yeah. And Dilipji was asking about what is your view on the framework for intangible assets recently announced by SCA.
Actually, they are just working on it. It's only a project that they have announced, because basically they want to see how the impairment, what the amortization of the intangible asset. It is one of the project that they have announced. So it's nothing. The information is still awaited from the IASB only. So I think even I think in the recent meeting they have just discussed it only, but they are just now their most discussion is on the sustainability standard as well as the IFRS 18, because that is going on implementation. Plus they are working on the IFRS 9 project. I think this is the recent agenda, maybe that will come in 2-3 years only. So that I think they are mainly their focus is on to include the crypto or the similar asset, because the FASB have issued a guidance on the crypto accounting, which IASB have not done. So basically they cover that as well with other aspect with respect to impairment and amortization of the intangible asset. I think what is in the agenda is not yet out, I think. So we have to wait until the further announcement.
Right. Yeah. And Ashish is asking about, for self-developed intangible assets, is there any option to charge the amount to P&L rather than capitalize it?
Actually, we cannot account it. Actually, if we have a brand which we self-generate, or if we have a goodwill which is self-generate, we cannot account it at. So there is no question of it cannot be recognized at all. There is no recognition. So there is no capitalization or profit and loss account there.
For self-developed intangible assets like any software.
If we have this internally generated software, we are not going to market it. We cannot account it. Now, if we incur any expenditure, that have to go to the P&L. That is the question, because it falls under the development expenditure, which you cannot market it. Otherwise, like if you have a brand, like or a patent which we have internally generated, that we cannot account it, because standard prohibit recognizing those items.
Raviji, you can unmute yourself. Let me just put it.
Yeah, thank you very much, Mr. Ranjit. Very interesting indeed. Just one question, please. I'm talking about stocks and shares. In the investment in the stock market in America, say you buy a stock of, say, $100 in, say, 2022. And then at the end of the year in December 22, the market value fell down to 90. Next year, it fell down to 75. And December 24, it went up to 120. Unrealized gains and losses are booked in the accounts as per IFRS, which is clear. But we have opted for the realization basis for CT purposes. My question is, can I use 100 as my cost when I sell it next year or year later or whenever? That's my question.
No,
my cost is the original cost, not the last, not on 1/1/24, which is the commencement of the tax period.
Because how the tax work is that whenever we sell it, the profit is calculated based on the sale price and the carrying amount at that point of time. Then whatever gain or loss which we have not offered for tax, that also we have to offer for tax on the time of sale. Okay, it basically, if we work it out, it went back to the original cost, but computation is based on sale proceeds minus carrying amount. And if I have not taken the gain or losses earlier, those gain or losses which I have not offered for taxes, I have to offer it now at the time of actual sale of shares. So plus minus.
I'm trying to reduce my gain for taxability. This is what I'm trying to do, because I'm adjusting the cost to 1/1/24 as 100, whereas I bought it 2 years prior to that. Is the question, is that allowed?
Actually, the accounting wise, it is not allowed, because tax laws also says that whenever you go for realized basis, you exclude the gain or loss. When you actually sell it, you calculate the profit as sale proceeds minus carrying amount, which is a value as per the books. That profit plus whatever is not taxed earlier, either gain or loss, that also you have to take into account. That will be the total gain or loss taxable in the realization event or in the year of sale.
Okay, thank you, sir. Thank you very much. Very interesting. Thank you.
There's one more. Hope we'll just wind it up in a couple of minutes.
No issue.
Goodwill impairment is tax deductible expense, right?
It again depends upon the option that we have selected. If we don't elect it, because the tax, unless they come up with some other decision, the tax law says that if you're following IFRS, that is followed for tax purposes. So if we impair a goodwill as per IFRS, it is tax deductible. Only thing is that, again, if you have opted for the realized basis, that will be an unrealized item. So that will be adjusted according to the election you have made. Otherwise, it is the thing.
Yeah, I think one last thing is with respect to the same internally developed intangibles, if the product or the software that they are developing, if it is for sale, then his question is that any expenditure incurred for developmental phase, can it be expensed off instead of capitalizing it?
Because the standard says that if we are developing something and we are incurring any expenditure, and from that we can generate future economic benefit, that expenditure have to be capitalized as an intangible asset, right? Because we don't have a choice there. Only thing is that if the product is not marketable or we are not expecting the future economic benefit concept, then we have to write off it to the income statement. But if the product is marketable and we can expect, it's an asset, so it have to be capitalized as per the standard. We don't have a choice there, actually.
The answer is no. Then we cannot.
The answer is no. Yeah, correct. Yeah.
Great. I think that's all we have.
Okay.
Thank you very much, Ranjit ji, once again, and thank you all for attending this session.
Yeah.
Definitely, it was useful and insightful, as we can see in the comments also.
Yeah.
Once again, thank you very much, and thank you all for attending. And then good night. Take care.
Thank you. Thank you all. Have a good evening.
Thank you, Ranjit.
Thank you. Bye.
Thank you, Balram.
Bye.
Thank you. Thank you.
Bye.
You should definitely thank our chairman also, and then comment.
Definitely.
Thank you.
Thank you.
Bye.